Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
And the other, principal actors, if you want to define global rebalancing this way, you have what's called the periphery countries, the emerging market countries of the world, and then you have the center, and the center the U.S. is primarily at, Europe, center being the deep capital markets. And although it's changing, and it will change, obviously, as the emerging markets continue to grow and develop their own capital markets, the problem still is that these emerging markets are dependent on the center capital markets, U.S., Eurozone, to move money liquidity out to them, which is happening in a very big way, and that's part of this whole dollar devaluation that we're seeing. The money created by the Fed, money created by the Bank of England, European Central Bank, and Japan to a lesser degree, Bank of Japan. Very low yield in those countries, very low growth rates. So investors take all that liquidity being created by the central banks and also on the fiscal policy side. I think of taking that money and moving it out to growth and yield, so that money is created in the center and goes out to the periphery. And of course now the concern is major bubbles in the emerging market area, because there's so much money being created here to try and stimulate local demand in the industrialized countries, but so much of it is leaking out into the emerging market world. And of course the emerging market world, if you double back to our boy China, it has to compete against China. So all these countries that are similar to China with the export models have to compete about China. But the problem is China has a fixed or pegged currency, so to speak. It's supposed to crawl and it's supposed to move against the basket, but basically we know it's been fixed against the U.S. dollar. So therefore, these periphery countries, ex-China, that are getting this money flow are having their FX rates pushed up when China is not. China is basically equal. Now I say that even though Chinese have allowed their currency to appreciate pretty fast over the last 3 or 4 weeks. It's up about 2.3%, which isn't anything to sneeze at. But on a relative basis, because all this money going into the emerging market is pushing their currencies up relative to China, and they have to compete with China on trade, exports to the West. Obviously, this is creating these currency tensions that we're seeing all across the world and in the headlines, and it comes right back to global rebalancing. The interesting thing is the fact that the market, as I said, the credit crunch was a signal that this rebalancing should start taking place. But instead of allowing the rebalancing to take place, the governments of the world are doing all they can to keep this game alive, because it seems to be the only way to keep any type of growth in the world, meaning the emerging markets, China, the major driver of demand in the world, is predicated on this whole imbalance problem. But the fact is, the market said the imbalance problem, the additional leverage being thrown into the market, and the lack of core wealth staying within the U.S. Was the problem. So oddly, we're kind of back in the same boat. And if you look at the, as I said, the poster children here, you look at China and the U.S., the global imbalances have gotten worse since the credit crunch. How we measure that is, if you look year on year through July 2010, U.S. The portion of the U.S. trade surplus, China's trade surplus going to the U.S. represented 172% of its global trade surplus. Prior to that, the previous high was 144%. So in fact, it's gotten worse from the U.S. and the China standpoint, and they're the two key players here. If you look at the key surplus players in the world, as we just talked about in a different form, China, Germany, Japan, and the emerging bloc countries. These countries all are export-dominated players. They need to export in order to drive the growth that they've had in the past. These are the major key consumers or deficit players in the world. The problem is these guys now want to do some exporting, and they want these guys to start doing a lot more importing. And that's really the basis of global imbalancing. The touchstone, or the linchpin, obviously, again, is China and the U.S. So the fact of the matter is, everybody can't export, especially in a world where global demand continues to be, I guess, fair. It's pretty bad, low at best, I guess, slightly growing, but nowhere near when the bottom dropped out and the credit crunch as global demand come around. So you can't have areas like the U.S. and the Eurozone with their consumers in big trouble, Eurozone area, ex-Germany going into major austerity, which means they're going to consume less. The U.S., obviously, as we know, hasn't rebounded whatsoever, so they're not taking the goods that they did in the past. So this is creating the tensions. This is creating huge global tensions in the world. China's become more belligerent of late. We've seen some movements on that, and I'll get by China, and I'll get to that in a second. But up until recently, very belligerent on the currency front. One of the things I don't show in this presentation, and it's a reality for China, is if they were to have some type of one-off massive appreciation in the currency, 30, 40, 50%, they are right to say it would be a major dislocation for them, which is interesting because for many years they said the currency didn't matter, but all of a sudden now the currency does matter. In a world in which demand isn't out there, they realize that the currency does matter, and it's mattered all along. But to get back to the point, if they were to have a major revaluation, they would see that as what happened to Japan in 1986 through 1989. The Japanese currency went through a major revaluation effectively through what was called the Plaza Accord, where the major governments of the world got together to push down the value of the dollar, which was the main theme. But implicitly, it was to push up the value of the Japanese yen because Japan was blowing and going, and was China at the time, major credit capital, major world power from capital standpoint, buying everything around the world. Huge bubble in the stock market, huge bubble in real estate, and as the currency started to move higher, the Plaza Accord led to some other dislocations. We had the 1987 stock market crash, and that took once again, the U.S. consumer out of the market for a little while. Back in 1987, when we had the stock market crash, we saw a slight improvement in the U.S. current account deficit at the time. And just that minor improvement in the U.S. current account deficit was enough to take demand away from Japan at a time when they were their currency was being tightened and they were in a major bubble, very, very much like China today.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.